Your mortgage rate wasn't chosen by your bank. It wasn't set by the Fed. It was set by a $145 trillion machine that most Americans have never looked at once in their lives. And in 2022, that same machine caused the so-called safe part of millions of retirement portfolios to lose 16% in a single year. Safe, 16% gone. Today I'm going to show you exactly how that machine works and exactly what every move it makes costs you in real dollars. Let's get into it. Welcome back to Money Made Simple, where we break down US money topics in plain English. No jargon, no fluff, just what actually matters. Hit subscribe if you're new. Let's go. Let's start with the basics. Because bonds have a reputation for being boring and complicated. They are neither. A bond is just a loan. A government, a company, a city needs money. Instead of going to a bank, they borrow it directly from investors like you. You hand over a fixed amount called the principal. They promise two things in return. First, a fixed interest payment every year called the coupon. Second, your principal back on a specific date called the maturity. That's it. That is the entire instrument. A piece of paper that says, lend me money now. I'll pay you interest every year. And I'll give it all back on this date. Bonds are not complicated. What makes them powerful is the scale at which they operate. The U.S. government alone has borrowed $39.2 trillion through bonds. The interest payment on that debt, not the debt itself, just the interest, is $1.05 trillion per year. That's $2.88 billion every single day. The U.S. government spends more on bond interest than it does on national defense. And every dollar of that interest comes from your taxes. Now here's the one rule that explains everything else in this video. One rule. Master this, and you'll understand more about bonds than most Americans ever will. Stay with me. When interest rates rise, bond prices fall. When rates fall, bond prices rise. They always move in opposite directions, without exception. Here's why. Suppose you buy a $1,000 bond paying 3%. That bond pays you $30 a year. A few months later, the government issues new bonds at 5%. Those new bonds pay $50 a year for the same $1,000. Now you want to sell your bond. Nobody will pay $1,000 for it because they can buy a new one paying more. The only way to sell it is to drop the price until your $30 payment becomes competitive. At 5%, that price is about $600. You haven't lost any future payments. The bond still pays $30 a year and returns $1,000 at maturity. But on paper, your $1,000 investment is now worth $600. That is the rule. And every financial disaster in the rest of this video is just that rule operating at a larger scale. Now here's where it gets personal. Of all the bonds in that $145 trillion market, one matters more than any other to your daily life. The 10-year U.S. Treasury, currently yielding 4.5%. When a bank decides what mortgage rate to offer you, it does not invent that number. It looks at the 10-year Treasury and asks one question. Why would I lend money to a household for 30 years when I could lend it to the U.S. government for 10 years risk-free at 4.5%? The answer, it wouldn't, unless you pay more. So the bank takes the 10-year yield and adds roughly 2 percentage points to cover the extra risk that you, a regular person, might lose your job or default. Right now, the 10-year is at 4.5%. Add 2 points. The national average 30-year fixed mortgage rate is 6.52%. The math is that direct. Let me show you what this costs in real dollars. Meet Brian. Brian is buying a house. He needs a $400,000 30-year mortgage. At today's rate of 6.52%, his monthly payment is $2,534. Now imagine the 10-year Treasury rises by just half a percentage point. A routine move the bond market completes in a single trading week. Brian's rate rises to 7%. His new payment is $2,661. That is $127 more every single month. Over 30 years, that half-point move in a bond market Brian has never visited costs him $45,000. 1 percentage point up, the cost jumps to almost $97,000. The bond market handed Brian a $100,000 bill without ever sending him an invoice. Now here's where most people think, okay, that's interesting, but I don't own bonds. This doesn't affect me. Wrong. Because there's a very good chance you already own bonds inside your retirement account right now. And what happened in 2022 should scare you. For decades, the standard advice was simple. As you get older, move out of stocks and into bonds. Bonds are the safe part. Stocks grow your money. Bonds protect it. The classic 60-40 portfolio, 60% stocks, 40% bonds, was sold as the conservative sensible default. The bond half was supposed to be the seatbelt. In 2022, the Federal Reserve raised interest rates faster than at any point in 40 years. Apply the rule from before. When rates rise, bond prices fall. The broad U.S. bond market lost 13% in 2022. The worst calendar year in the index's history going back to 1976. The S&P 500 fell 18% the same year. A 60-40 portfolio, the supposed conservative default, lost about 16%. The seatbelt did not catch anyone. It was attached to the same crash. And the longer the bond, the worse the loss. Long-dated treasury bonds lost 39.2%. A Santa Clara University analysis found that 2022 was the worst year for long-duration U.S. bonds going back to 1754. Not 1954. 1754. The United States didn't even exist yet, and the safe sleeve of America's retirement portfolios was having its worst year in 268 years. There is one number that explains why some bond funds got destroyed worse than others. It's called duration, and it is printed on every bond fund's fact sheet where most investors never look. Duration tells you how much your bond fund will lose for every 1 percentage point rise in interest rates. Consider a retiree with $500,000 in what she believes is a safe bond fund. If her fund has a duration of 6, typical for a broad bond index fund, a 1-point rise in rates costs her $30,000. If her fund has a duration of 17, typical for a long-dated treasury fund, that same 1-point rise costs her $85,000. Same retiree, same $500,000, same rate move, $55,000 difference. Most people who own bond funds have no idea what their duration is. They were told bonds are safe and stopped reading. Duration is the difference between a small bruise and a broken leg. Now here's something most people don't realize about bond funds specifically versus owning a bond directly. This distinction could save you from the exact mistake millions of retirees made in 2022. Pay attention. This is important. If you buy an individual bond and hold it to maturity, the price drops along the way mean nothing. You collect every coupon payment, and you get your principal back at the end. You can ignore the rule completely. A bond fund is completely different. A bond fund never matures. It is a basket of bonds that gets repriced every single day. When rates rise, the losses show up on your statement immediately. And they stay there. The 2022 losses we just talked about were real. They did not disappear when the year ended. This doesn't mean bond funds are bad. It means you need to know what you own and what its duration is before rates move. Now let me show you the most powerful predictive tool in all of finance. It's called the yield curve, and it has predicted every single U.S. recession for the last 70 years. The yield curve is simply a chart that plots bond yields from short maturities to long maturities. Normally, short-term bonds pay less than long-term bonds. That's the normal shape. Occasionally, the curve inverts. Short-term yields rise above long-term yields. When that happens, the bond market is making a specific prediction. It expects the economy to slow down enough that the Federal Reserve will be forced to cut rates. According to research from the Federal Reserve Bank of San Francisco, every single one of the last 10 U.S. recessions going back to 1955 was preceded by an inverted yield curve. 10 for 10. Over 70 years. No other recession indicator comes close. When the yield curve inverts, the bond market is making one of the loudest statements in all of finance. And most Americans have never heard of it. Now let me show you something that applies to everyone watching, whether you own bonds or not. The FDIC reports the national average savings account pays 0.38%. That is the rate at most of the largest banks in America. Meanwhile, 3-month U.S. Treasury bills currently yield 3.71%. The best high-yield savings accounts pay around 4.2%. All three are essentially as safe as money in the bank. T-bills are backed by the U.S. Treasury. High-yield savings accounts are FDIC insured. Same money, same safety. Dramatically different yield. The only difference is which institution holds your cash. Let me show you the cost in real dollars. Suppose you hold $50,000 in a typical savings account at your neighborhood bank, earning 0.38%. That balance earns you $190 a year. If that same $50,000 sat in 3-month T-bills at 3.71%, it would earn $1,855 a year. The Treasury option earns almost 10 times what the savings account does. On identical money, with identical safety. Over 5 years, leaving your money at the bank costs you $8,325 in interest you could have collected for free. That is not a small thing. So what do you actually do with all of this? Here are 3 specific actions. Action 1. If you own bond funds inside your retirement account, find the duration number on the fund's fact sheet right now. Anything above 7 means your fund will move meaningfully when rates change. Anything above 15 will behave more like a volatile stock than the safe seatbelt you were sold. Knowing the number is not optional if you own the fund. Action 2. If inflation is a concern, look at I-bonds. The U.S. Treasury issues Series 1 savings bonds that pay a rate that adjusts with inflation. The current rate through October 2026 is 4.26%. There's a $10,000 per person annual purchase limit through Treasury Direct. But for cash that needs to keep up with the cost of living, I-bonds are the most direct inflation hedge available to a regular saver. Action 3. Check the 10-year Treasury yield. It takes 5 seconds. When it climbs, mortgages, car loans, and corporate borrowing climb with it. When it falls sharply, the bond market is usually bracing for a slowdown. It is the closest thing the economy has to a check engine light. Now you know what it means. Quick recap. Bonds are loans simple. When rates rise, bond prices fall always. The 10-year Treasury sets your mortgage rate directly. In 2022, the safe part of millions of retirement portfolios lost 16% because most people didn't understand duration. Your savings account is probably paying you 10 times less than a Treasury bill for identical safety. The bond market touches your mortgage, your retirement, your savings, and your job market. Every dollar in your financial life is priced by it. The people who understand how it works are not smarter than you. They just stopped pretending it was boring. Write that down. Now I want to hear from you in the comments. Did you know your mortgage rate was set by the bond market? And do you know the duration of your bond funds right now? Drop your answer below. I read every single one. And if this video connected dots you didn't know were connected, hit that subscribe button so you never miss another breakdown like this. Check out the video on screen for more ways to understand your money. See you in the next one.